All right, welcome everyone. Just finishing the setup over here. There we go. Okay, so welcome everybody, and today we will be talking about, well, what ETFs and what sectors are on sale right now. So this should be a pretty straightforward presentation and live stream. And now, as always, you have any questions, I'm just moving up here my little chat window that way I can actually see what everyone's saying. And feel free to ask me anything. If you have any questions, feel free to ask any of them right now as we're getting started. All right, so very important disclaimer, as usual, I don't have a official certification as a financial planner or advisor, and I do not claim to be one. So very important to know. Again, this live stream is provided for information purposes only, information/educational purpose only, and does not constitute investment advice. So please do your own research and figure out whether any of the things that I'm about to tell you are right for you. All right? Okay, so before we start talking about which actual sectors are on sale and which associated ETFs can actually match said sectors, it's very important to first of all figure out whether you should be investing right now. Now, this slide, I've covered this in a previous webinar, but it's incredibly important to repeat. So I'm gonna just spend maybe a minute or so on this very quickly, because when most people lose money, it's not when they're actually invested in the wrong thing, but it's because basically they're invested in the right thing in certain cases, but at the wrong time for them personally, right? So yeah, sure, sometimes people invest in things they really should not be investing, but more often than not, they are investing in the correct stuff, in the correct assets, in the correct proportions, but they're not investing at the right time for them personally. And right now, again, many investors typically tend to argue that it's a good idea. The best time to invest is basically when everyone is, invest when others are fearful, as Buffett has said. You might have heard, invest when there's blood on the streets. In other words, all of those individuals seem to agree that typically whenever there's an economic downturn, whether there's trouble, if you can identify the right sectors or even just the broad market in general, you will definitely do really, really well. The problem is, or the question is, can you personally currently afford to start investing? So first question I always ask my students, do you have any high interest debt? Do you have any credit card debt? What is high interest? Anything, honestly, these days, anything above 7% or more should be considered high interest debt, okay? Anything in the roughly around 20%, which is most credit cards, that for sure is high interest debt. There's no point in you risking in the investing markets, trying to time the market, doing any of those things, when you have high interest debt, credit card debt at 20%, or even other forms of debt at 7+%. If it's around 2%, 3% like mortgages, that's a different story, right? But when you're dealing with debt 7+, or especially when you're dealing with debt at 20+, get rid of that debt first. There's no point in wasting money on investments. And sure, there are some investments that might be able to do a lot better than that within a year, but they're not consistent. And again, I'll show you some of the ones that we will be talking about today. They've dropped recently in price by over 40% or thereabouts in certain cases, with minimal recovery. But just because they were a certain price before now, it doesn't mean that that was the right price. Maybe the right price is twice as much as it used to be, or maybe it's a half as much as it used to be and it's currently overvalued. So no one knows for certain, but again, I'll show you a few tools and a few websites where you can find out more information to do your own research and figure things out. All right. So if you have high interest debt, get rid of it. Then think of investing. And furthermore, even like kind of your second step, if you will, have at least 6 months worth of emergency savings, or at least some form of revenue generating income source. Again, a lot of people have lost their jobs, hopefully only temporarily, but realistically speaking, in many industries, we'll see massive shifts, which again, we'll be talking about some of those shifts in literally like 5-10 minutes from now. how secure is your job, right? This sort of has a lot to do with this, because then if you can argue, well, you know what, I'm a lifer at this company here, or at this in this government institution, and the likelihood that I'll get fired is pretty much zero. Or you're a tenure track professor or something like that, and your job is secure and you have a defined benefit pension, all those things. That's a different story, right? Then you don't necessarily need that 6 months worth of emergency savings. But the average person is not in that position where they have a job for life guaranteed, right? So also think about it, how secure is your job, to figure out, whether 6 months is enough for you in terms of emergency savings. And then can you afford to stay invested for the long term? So long term here is at the very bare minimum is 5 years plus. Again, it's anyone's guess how quickly or how slowly the economy will recover. For sure, certain sectors will do better than others in the short term, and then so some of the ones that have done really well in the short term might start slowing down a bit in the longer term as other sectors start revamping, as money gets shifted from sector A to sector B, and so on and so forth, and money starts flowing back into the economy. And then the big unknown is, how bad will be the second, third, nth wave, and how many of these waves will we get, and how quickly will we find ways to treat or at least immunize ourselves against COVID-19. So all those, it's anyone's guess, right? So because of that, even under normal circumstances, when you're investing and we don't have a global pandemic to deal with, you should really not be investing money for if you have at least 5 years plus, ideally that should be your time horizon. So especially these days, 5 years is really the bare minimum. You should really be looking at like 5 to 10 years, because that way, keep in mind, it's not when people don't lose necessarily money because they've invested in the wrong thing, although that does happen as well. But more often than not, they've invested in the right thing, and they're just selling at the right or the wrong time. Why are they selling at the wrong time? Sometimes perceived, they might act emotionally because the price has dropped by X percentage points, or the price might have gone up by X percentage points. Like, oh my God, it's a great time to sell, or oh my God, I better sell now because I rather get 50 cents on the dollar than getting zero. This perception that things will go to zero. And again, if you avoid individual stocks, your likelihood of going to zero are pretty much zero, right? The larger your investment portfolio, the more things you're investing in, the likelihood that every single one of those things, and especially those things are distributed throughout the world, Canada, US, international markets, bonds, etc., preferred shares, REITs, the likelihood that every single one of those companies, every single one of those countries goes bankrupt at the same time is pretty much nil. And if they do happen to go bankrupt at the same time, well, a massive world event happened that destroyed, a giant chunk of the population or whatnot, and would be much, much worse than COVID-19. So at that point, even if you have money, sitting under a mattress, I don't know what its value would be, right? So not investing in the markets because you fear that what if markets drop? Yeah, sure, they might drop, but again, get rid of high interest debt so you're not forced to sell in a falling market. Make sure you have at least 6 months worth of emergency savings, again, to buffer those fluctuations. Ideally, if you have a secure job, but again, there's not much you can do about this part, right? You're not really controlling this, but you can control how much debt you have, like just pay it off, don't invest beforehand. You can control how much you have in emergency savings. And then finally, stay invested for the long term. And 5 years is really the bare minimum, as I said. Ideally, 5, 10 years plus really is what you're looking at, okay? So anyway. Now, all of this being said, on the next few slides, I'll be talking about 5 different sectors that have substantially dropped in price. Some of them are geared towards bouncing back relatively quickly. Others are geared towards bouncing back, but a bit at a slower rate. And we'll discuss the pros and cons in those different sectors. But before I start talking to you about sectors, please be aware that, again, survey, and a ton of research and survey after survey, poll after poll, has found time and again that index investing, in being invested in a balanced, diversified portfolio, right, that we've discussed in the past on a few occasions, typically beats between 70 and 95% of investors. All investors out there, professionals and amateur retail investors included. Now, the reason there's a big range, again, depending on which poll, which study you're looking at, whether they're including the management fees or not, etc., etc. This is why you have a relatively large range. Most of them typically tend to quote between 80 and 90, but you have some that say, index investing beats 95, and others that go as low as 70. But nonetheless, index investing in the vast majority of cases tends to beat most other strategies for most people. It doesn't mean that there aren't unique individuals, unique circumstances where individuals and sectors will outperform the market averages. But again, keep in mind, it's incredibly difficult, even for professionals that do this full time, to accurately and consistently, the keyword there being consistently, time the markets. I've timed the market perfectly on a few occasions. Yes, I did a bit of research, but a lot of it was honestly luck. If I was to be honest with you, yes, I did research, but I had about a 40% chance of being wrong. So I had a better than average, better than 50%, but it wasn't much better than 50%. And if most professionals are honest with themselves, in most cases, I dare to say, their forecast might be 55 to maybe 75% in an absolute best case scenario, correct or accurate, right? Meaning that typically about 2 out of every 5 or thereabouts forecasts that they're making will be wrong. And then obviously over long periods of time, that difference between being wrong and being right, well, you end up winning. If you win, your losers are less are smaller than your winners, then your winners make a lot more money. Then at the end of the day, you'll make money. But the key thing is, again, in most cases, the indexes, just investing in the full market, will beat most strategies, including the one I'm about to tell you, right? So my point is, looking at specific sectors is a strategy. I'll show you 5 potential sectors that might be of interest right now. Are they right for you? It depends on a multitude of facets. Will those sectors recover at the rate that I'm expecting them, and at the rate as various other professionals expect them to recover? Which again, I've been reading a number of articles looking at and publications about analysts looking at each one of these sectors, and I'll kind of convey my my message in a couple of minutes for each one of those sectors. But are they right? Is my analysis right? I don't know. No one knows. So just be aware that I'm about to tell you about 5 sectors that might outperform the market indexes, but statistically speaking, more often than not, it's really broad, diversified portfolio. Lower your fees, eliminate your taxes legally. If you're in Canada, TFSAs are probably your number one bet. If you're a higher income earner, you get employer matching, etc. Things we've discussed in the past and things we will see in the future, in future sessions. RSPs are really good too. If you have kids, RDSPs, etc., etc., etc. To either legally eliminate or defer your taxes, whichever case may be. Now, I'm not going to spend any time on this. I've explained this graph at least on 2 separate occasions in the past. But if you weren't here before, all this shows is that what is the longer your time horizon, right? So the more years you're invested, the more likely even the worst case scenario ends up being a positive rate of return, right? So if your timeline is one year, no one knows 1 year. You should not be investing in a market even under regular circumstances when you need the money within a year from now, because you're about to buy a condo, you want to buy a house, you want to go travel the world, what have you. Hopefully by next year things will resume in terms of world travel. So you see, according to this 54-year study, best case scenario, you might end up with 87% or 86.93. Worst case scenario, you might lose 39.13% of your or 0.16% of your investments. So 1 year, it's gambling. It's anyone's guess. Yeah, you're statistically more likely to make money. As a matter of fact, about 73% of the time, the stock market ends up higher than it begins the year with. But again, it's difficult to say with any degree of certainty. So once you're looking at 5 years plus, yeah, sure, you can still lose about 2%, but your chances of making money are quite high. And then once you're looking at really long term, worst case scenario, you'll make 6.95, best case scenario about 13.76. Now, the link to this is already in the description of this video. And yeah, long rate of return is typically for a balanced diversified portfolio is about 7% is what you can expect long term, compounded 7% per year. Now, all of that being said, again, that was a backgrounder for those of you that haven't been here for previous sessions, and it's important to know that backgrounder before you listen to any of the things that I'm about to tell you right now. So, which sectors are currently on sale and have at least some potential upside? Whether the upside will prove to be realized and will prove to be true. Again, only time will tell. But there's not much else you can do other than look at the sectors and try to guesstimate using best available data. So which sectors are on sale for an hour? Which ones have declined significantly in price recently? Now, airlines, surprise, surprise, I'm sure no one's surprised. Airlines have actually experienced a massive drop in their profits. Now, their share prices have also dropped significantly. Interestingly enough, depending on which airlines you're looking at. Interestingly enough, though, the share prices of certain airlines have actually decreased less than the value, than the profits of the companies, than the underlying profits of the companies. Because again, most airline companies are probably operating at about 5 to 10% capacity right now, if that. So, technically speaking, in terms of revenue, their revenue is down 90 to 95%, yet most share prices haven't collapsed by 90 to 95%. They collapsed by anywhere from about 25 to about 60%, depending on which airline you're looking at. So airlines have dropped, and again, we'll discuss about how this might be a play for some people. Now, keep in mind, airlines in general, it's a very cyclical. Market, and I'll show you what I mean in a few minutes. So right now it's still cycling, but it's the price has dropped significantly. So you're expecting kind of a recovery, but then once it recovers, do expect fluctuations, ups and downs. Those are normal, even if no other bad news comes in the meantime, right? So airlines would be number one. The second sector that might be of interest are banks. So a lot of banks, especially if you're looking at Canadian banks, which are very solid, especially if you're looking at the 6 large Canadian banks, so RBC, TD, BMO, Scotiabank, and CIBC, and then you can add, I guess, a 6th one there with National Bank. Bank stocks have been impacted quite significantly. A lot of the fear, obviously, why have airlines been impacted? Just because I forgot to mention this before, why have airlines been impacted? Well, obviously, if you're only operating at 5 to 10% capacity, you're only operating about 5% or thereabouts of your routes, and even then, there's just a handful of passengers per plane. No wonder that Air Canada had to let go of about 20,000 employees, and many other airlines around the world have done similar or the same thing. Right? But the idea, why could it recover? Well, when things recover, it's not a question of if, it's a question of when. Obviously, there will be pent-up demand for travel, especially going on vacations and what have you. Now, one part of the whole airline industry that might have a hard time recovering or might take a lot longer to recover is the business travel sector. Why? Well, again, it takes about 4 to 6 weeks to form a habit. And right now, most countries around the world have been under lockdown for much longer than 4 to 6 weeks in many cases. And even those that have reopened, they're still implementing a lot of social distancing rules. And virtually no large company that I'm aware of in the world really encourages currently its employees to travel to other clients remotely, other than obviously companies that are essential and industries that are essential where you actually need to send merchandise or you need to send employees to verify the safety and security of installations, things like that. But other than that, simply, other than the critical individuals, there's literally no travel. There's definitely no encouraged travel, right? And then as people get used to Zoom, even with the whole issue of Zoom fatigue and like all the other online, Google Meets and Microsoft Meets and all and so on and so forth, once it becomes the norm, it's a much tougher sell to, especially if airlines increase their prices because they'll have to leave every other seat empty. It's a much tougher sell to send your employees to go into a in-person meeting when you could just do a Zoom meeting, and it's become a lot more socially acceptable to have online meetings instead of in-person meetings. A lot of in-person meetings that were happening, that were occurring, were by tradition. And again, I've been saying this, if you've been following my webinars for the last few months, I've been saying this, and with live streams for the last few months, I've been saying this from day one, basically, back in end of February, even before the lockdown happened, that airlines are going to be hit pretty hard. Now, banks obviously have also been hit. Why? Well, the idea is, as people are losing their jobs, people will no longer be able to make their mortgage payments. Now, a lot of people don't really understand, or a lot of Canadians are not fully aware of how banks work in Canada and how the CMHC works. So keep in mind, the CMHC, so that's the Canadian Mortgage Housing Corporation, is a crown corporation, so it's owned by the federal government, right? So it's an institution belonging or being part of, in a way, arm's length of the federal government. And whenever you're buying if you're buying an investment property, you always have to have at least 20% down. If you're buying a secondary home, you always have to have at least 20% down. If you're buying your principal residence, depending on the price, if it's above $1 million, you have to have 20% down. If it's less than $1 million, currently it's 5% for under 500,000, and between 500,000 and $1 million, it's 10% of that difference plus the 5% for the first 500,000. Right now, they're Evan Sedal, the president or CEO, I remember I think he's president of CMHC, about 2 weeks ago or so, stated that he's recommending to the Canadian regulators and to the Canadian government to increase minimum down payment limits from 5%, even for the first $500,000, all the way to 10%, just to lower the risk that people are taking, right? And so what does CMHC insurance do? Well, you have to pay a certain percentage, and again, I'll cover this in a future session in more detail, but you have to pay a certain percentage of your mortgage if you don't have at least 20% down. And that percentage that you're paying is to get this insurance. Now, this insurance, your benefit is that you're lowering your interest rate. It allows you, because if you don't have at least 20% down, you represent a much higher risk. So normally the banks, the only way they would be allowed or willing to allowed or willing to lend you money is for you to demonstrate that you're actually able to set a certain amount of money aside and then make your payments. But when you haven't managed to save at least 20% down, you present a much higher risk because you're much more leveraged. Fancy way of saying you're borrowing a lot more money, and as a result, even a small drop in price of your home might make it so that you're underwater, which means you owe more on the house or the condo than what it cost you to buy it. So what people do not understand is when you pay that insurance, that's your benefit. Your benefit is you're getting the same low interest rate as everybody else that has managed to save more money. That's your benefit. The insurance, in case you're not able to make your payments, right? The insurance covers the bank, not you. If you're no longer able to make your payments, right? The bank says, okay, fine. Let's say if you miss 3 payments in a row, basically the bank has the legal right to foreclose on you, right? And if a bank does that, and let's say they try to, you're allowed to try to sell your house ASAP and get whatever money you're able to get. Obviously, if you're able to sell it for more than whatever you owe them, whatever money you owe to the bank, then you just pocket the difference. If, however, you sell it for less than what the outstanding mortgage is, because if house prices or at least condo prices were to fall, and a lot of people have argued that condo prices are likely to fall because of a number of things. So at that point in time, what tends to happen is that, and I just realized, sorry, I just remembered I'll say that the banks thing now, but that's technically speaking for another picture that is going to pop up here. This is actually for REITs, but doesn't matter. I just remembered. So everything I told you is correct. That's not an issue. I'm telling you the wrong thing for the wrong picture, but it doesn't matter. So with the banks, a lot of people think, banks are going to go under because what happens if people are no longer able to make their payments? It doesn't matter to the banks. They're insured. Like all of that is insured, and that is not insured by a bank or by a financial institution or or an insurance company, it's insured by the government, right? And the government, I mean, these days, they're throwing money left, right, and center to try to keep the economy afloat. So you could argue that, well, they're out of money, yeah, but they can just borrow more. It's not a good thing for the average Canadian, but it's just going to happen in case there are defaults. Hopefully, this won't be the case, but the 6-month deferrals that have been started in March, where basically people don't have to make their mortgage payments for the next 6 months, those end in September, right? So that's what Evan Sedal was saying, and many other economists have been saying and warning that basically in September, October, we're going to be having a massive issue, because unless the government extends those deferrals, unless the banks are okay with extending those deferrals, those people that weren't able to make their payments, yes, some of them, they might be lucky enough to be in an industry that will be reopened by then. But many will not be able to go back to work because they might have been entrepreneurs. They might have been working in the hospitality industry. You know, right now, roughly 5% of hotel rooms are in use globally. Barely any reservations are being taken on Airbnb these days. A lot of people have bought investment properties to use as Airbnb, you know, to become Airbnb hosts, right? And substitute their income that way. I'm not saying no one's going to be using our Airbnb. It's going to take a while for things to come back to some form of normalcy. Is that normalcy coming back in 8 months from now, 2 years from now, 5 years? I have no clue. This is why, again, if you're looking at these sectors, it's really you're looking at least 5 years plus. Anyway, so long story short, the stock prices of banks falling is really an overreaction, especially Canadian banks, especially the large 5 banks in Canada, are really well capitalized. They have really, really massive cash reserves. All those mortgages that people worry about, it's really the people are on the hook to pay those off. And if they're not able to pay them off, well, the CMHC will reimburse the difference between whatever the house is liquidated at and whatever the outstanding mortgage is. So the banks won't lose a penny on the whole thing. And then the CMHC turns around and basically sues the previous owner that wasn't able to pay their mortgage for the difference. And now you owe the money to the CMHC. And since the CMHC is a government agency, the only way to get rid of that debt is really to no longer be around because they're able, just declaring personal bankruptcy does not erase that form of debt. And because it's the government, they can simply garnish your wages. So every single time they might take, you might say, well, I cannot afford to make payments, but they might say, okay, fine, for the next 20 years, you're going to pay us $50 per paycheck, so you can reimburse us for the money we had to pay to Bank X to make good on your underwater mortgage. Anyway, so banks have dropped significantly in price, have recovered somewhat, but there's still a lot of upside for them. I'm not telling you there's zero risk there, but banks are definitely less risky than airlines right now. Airliners are a massive question mark. No one knows to what extent and for how long the airline industry will be impacted. Banks, however, especially the large Canadian ones, are much more solid, and especially if you're looking at buying the banks via an ETF, where basically you're buying a little bit of everything or of each one of them, your chance of losing money in the long term are very, very low. I'm not telling you there's no risk. I'm just telling you it's quite low. And there's a good argument to be made that it's likely that right now, since the bank ETFs have recovered less quickly than the overall market, they're bound to outperform the overall market, at least over a certain period of time. I cannot tell you by when. No one can tell you with certainty by when, because otherwise everyone would just be investing in those particular banks for that particular amount of time and sell it on that particular date. Anyway, so everything that I just told you, technically speaking, I should have been telling it to you for this picture. Now, this other picture, because I was debating which pictures to use for, describe a bank, and I figured, a vault is probably better than a bank tower, but this could also be an office tower. So this is also a very good representation of REITs. Okay, so everything I told you is correct. It's just I should have been telling it to you now instead of before. So this image here was really meant to symbolize REITs. So REITs stand for Real Estate Investment Trust. So that's REITs, if you've never heard of these. And on the 25th, I believe, of June, I'll actually spend a full 2 hours discussing kind of the top 5 REITs, or the largest 5 REITs in use in Canada. Today, I'll give you an example of one of them on the very next slide. And so I'm not going to spend much time on REITs, just because I will be covering that in much more detail in the future. And by the way, this session today and pretty much all future sessions, with a few exceptions, will stay public on my channel, so you don't have to worry about not seeing it. Some of my previous live streams, I would unlist them, and again, there were a number of reasons for that. I'm not going to go into it right now. So real estate investment trusts, the reason behind them dropping in price, well, first of all, what is a REIT? Real estate investment trusts are basically large companies that don't buy one condo, don't buy one rental property, but they're literally buying full office towers, they're buying full malls, they're buying entire industrial parks, right? They might buy an oil pipeline, some of them. They might buy a little bit of everything. So there are some that specialize in apartment buildings. There are some that specialize in office towers. There are some that specialize in retirement homes, for example. Now, a few years ago, I kept on telling people that some of the best REITs that are, in terms of outlook, are probably the ones specializing in retirement homes, because a few years ago, it was, to honest, the average investor and the average individual, I'm sure you've heard on the news, at least retirement homes in most of Canada, specifically in Quebec and Ontario, especially the private ones, no one was aware of the horrendous living conditions in some of those homes. All that people were able to see is that they were very profitable for the people that were operating them. So there were a lot of REITs that were specialized. There were a number of REITs that were specializing in retirement homes. Given that the world population is aging, especially in developed nations like Canada and the US, it makes perfect sense, as your population is aging, if you're looking at real estate income, to be investing in things that have to do with healthcare, specifically retirement homes, or some form or another of retirement home that deals with a lot of, because obviously there will be an increase in demand. Now, these days, while they're still profitable, there's a bit more uncertainty, because again, a lot of, and this is an ongoing thing, right? Until the Canadian Army issued that report about a week and a half, 2 weeks ago, with the horrendous living conditions in some of those in those 5 or 6 retirement homes in Ontario, and then we've seen in Quebec a couple of weeks prior to that, and that the name of the retirement home blanks. I'm blanking on it right now, but the one in the West Island, for example. So that has also scared some investors off, and obviously, as people sell their investments, the price drops, not because there's anything wrong with that investment per se. So there's a good argument to be made that things such as REITs investing in malls, they had been on the decline for quite a few years. Why? Well, because even before the pandemic, online shopping was gaining more and more traction. Amazon was gaining more and more traction. And now that's especially true, right? Most malls are still closed in Quebec, and unless you have, your store has a direct opening to the outside, and you're not in the greater Montreal area. So there's an argument to be made that those REITs will have a hard time being as profitable and might actually lose money over the next coming decade or so, because again, there's less and less demand for malls, or at least in the current context. Who knows? We might transform into something else. There's an equally valid argument to be made when it comes to real estate investment trusts that are investing in office towers, because you can imagine people working in large office towers that are owned by REITs in downtown Toronto, especially where there's no height limit to your skyscrapers, whereas again in Montreal you have the height limit, which nothing is allowed to be taller than the mountain, for example. So as a result, even our tallest buildings in downtown Montreal are tiny dwarfs compared to they're dwarfed by buildings in Toronto, or in New York, for example, if you're looking at our southern neighbors. And a lot of those office towers, yeah, sure, they might have 5, 6, 10, 20 elevators in their core, but each one of those elevators, normally they can maybe accommodate up to 20 people or so. In most cases, unless you're living somewhere where the governor or the premier doesn't care about social distancing anymore all of a sudden, or again, we figure out a way to not worry about social distancing anymore, you won't be able to use those elevators to their maximum. Many people, in many places, the limit is 2 people per elevator, 4 people per elevator, 1 person per elevator when the elevators are really, really small. And it's just incredibly ineffective and inefficient to have, an office tower that might house 3, 4, 5,000 workers a day, and trying to get those people with 20 elevators, 1 or 2 people at a time. It would take you hours just to get everyone to their right offices. And while walking up the stairs is a good exercise, what do you do when you're working on the 75th floor, right? like there's a lot of cause for concern for that, and you could argue very reasonably that if these measures have to remain in place for a prolonged period of time, those REITs will suffer, because obviously more and more companies will probably start downsizing and trimming the number of offices that they need, even if they're not firing anyone. But companies like Twitter and many other ones have announced that even after the pandemic is over, even if basically a cure is discovered tomorrow, they're perfectly happy, perfectly fine, allowing any employee that wants, going forward indefinitely to work from home to be allowed to do so, right? And if you think about it, it's good for the environment. You're cutting down on pollution. You're cutting down on people's commutes. It's less stressful in many ways. Although, again, there are downsides of being locked up in your house. So just imagine working from home when you're allowed to go and hang out with your friends in an environment where, imagine last year when you were working to be allowed to work from home. But none of the other restrictions are in place. So that would be a lot less stressful, because I know a lot of people are going a bit crazy, especially if you're stuck in a small apartment these days with the restrictions. And a lot of people can't wait to be able to go to an office and actually interact with humans in person, right? But so long story short, yes, there are some potential issues with real estate investment trusts. You can even argue that certain condo towers might have issues with people, especially the people that are a bit more fearful, or in areas that are more heavily impacted. Many people that would have otherwise wanted to live in a condo because it's convenient, because it's close to the office. If your office is online, you no longer have to live downtown. You can live, in the middle of nowhere. As long as you have broadband internet, you're happy, right? And so, especially with 5G coming up in the next couple of years, and so on and so forth. So, real estate investment trusts, some of them will probably do fine. Some might have issues. In those cases, I probably say it's, if you're a bit if you tolerate a bit less risk, maybe stay away from real estate investment trusts that specialize only on one type of industry, or they're specializing on office towers, for example, and buy REITs that are a bit more diversified, or ideally buy an ETF that holds multiple REITs. Now you have a little bit of everything. Now, I don't think so. Because of that, REITs are severely undervalued right now in many cases. And yes, there is a downside, which I hope I made it very clear that there are downsides to them. But I'm still confident that real estate investment trusts represent a much, much, much lower risk than buying an individual investment condo or investment property right now, okay? Keep in mind, I'm not a licensed advisor, but just looking at the broad spectrum of things, that sort of makes a lot of sense. All right, so what other sectors or what other asset classes? Well, preferred shares. Again, there was no better image that I could figure out with preferred shares. So in case you're wondering, again, most companies, or many companies, I should say, will issue different types of shares that have different, they have different levels of ownership, or they give you different benefits. So the most basic distinction is that typically preferred shares either have voting rights and the common shares of that company don't have voting rights, or vice versa, right? So that's a distinction between the two of them. And typically preferred shares, they're a bit of a hybrid product. So they are shares, they give you part ownership, but sometimes you might have voting rights, sometimes you might not have voting rights to vote for the company's directors, for example. Again, you have to look at each individual company's constitution to figure that out. But the reason they're a bit of a hybrid product is on the off chance that the company goes bankrupt, there's a pecking order of who has to be repaid, right? Whose money has to be repaid. So typically, among the first people that have to be repaid when a company files for Chapter 11 bankruptcy, they typically have to repay any outstanding taxes, whether they're municipal, provincial, federal taxes. They have to repay any landlords that they owe money to. Some of those landlords might actually be REITs, right? So they're pretty high up on that. They have to repay their utilities if they haven't made any payments for that. So as they're liquidating their computers, as they're liquidating the machinery or whatever the company has in terms of assets, they have to start repaying those individuals. Then they have to repay also the banks that have lent the money either directly or via bonds. So if you're a bondholder, you also get paid back there. And then right after those individuals, typically you have the preferred shareholder. So for a common shareholder, regular common stockholder, to get a single penny of his or her money back, the regular the preferred shareholders have to be repaid in full, and all the other people typically that are ahead of them have to be repaid in full, unless it's very clear from the get-go that a given company has nowhere near enough money. And sometimes you might have a kind of a general agreement between the various parties that are owed money to, and then some, the first level individuals might agree to only get 95 cents on the dollar, and the next people might agree to get 80 cents on the dollar, and the next people 75 cents on the dollar, and so on and so forth. That way at least everyone gets at least something back. So those also exist sometimes. But the point being, preferred shares are typically a bit safer than common shares, but nonetheless they've dropped significantly. One of the main reasons they've dropped significantly is that, again, there are different subtypes of preferred shares. I will cover this in a future video, so watch out for it for probably late July. But the main subtype of those three main types, the main subtype is called rate resets. Okay, so rate reset preferred shares are basically preferred shares whose interest payments are linked to one extent or another to whatever the overnight rate is set by the Bank of Canada. And I realize for those of you that aren't familiar with that terminology, this was just sounded like random words splattered all over. It's very simple to understand. So these preferred shares, how much they pay you, right? How much they pay you on a regular basis in dividends, that's linked to whatever the Bank of Canada interest rate is. So, right, the Bank of Canada overnight rate, that's what it's called, the interest rate set by the Bank of Canada. That one is set, or was set before this mess started, at 1.75%. Then they've lowered rates a couple of times. Right now it's sitting at 0.25%, matching the absolute historic all-time low, which was hit at the peak of the financial crisis in 2009. So now we're back to 2009 low interest rates levels, and because interest rates have dropped significantly, as a result, those rate resets also drop the amount of money that they typically pay you in dividends, and because of that, they're less appealing to investors. And because they're less appealing to investors, supply demand, people are selling them, not as many people want to buy them. As a result, their prices are lower. But typically they're a safer asset. They should make between 15 and 20% of your portfolio, according to most financial advisors these days. 10 to 20%, most say 15 to 20% or thereabouts. All right. And then finally, the fifth sector that I'm going to be talking to you about today that has seen a significant decline is obviously oil. And I don't think this comes as a surprise to anybody. Now, every single one of these, I think, actually have, significant upside. Out of all of these five, I would argue that probably airlines are the riskiest one, because there's the largest number of unknowns with airlines. How many countries will allow free air travel? Because even if countries say, okay, fine, we'll allow planes to start landing freely, but you require people to sit out or wait out a 2-week quarantine before they're allowed to go anywhere. How many people have 4-week vacations, right? Or are willing to take a 4-week vacation in one shot, 2 weeks of which are going to spend in some dank hotel room close to the airport because you're not allowed to go to the beach where you wanted to go, or you're not allowed to travel, the back country where you wanted to go hiking, for example, or go whatever it is that you want to do, right? So because of that, even if governments reopen, right, and allow for free air travel, depending on the rules and regulations each individual country keeps, or maintains, including how far apart people have to be on airliners, what type of PPE they have to wear, if any, or if it's up to the airliner, and then if someone gets sick and gets the whole plane sick, is then the airliner going to be, or that company going to be liable, and then what would that do to their share price? Like, there's so many unknowns that, yes, airliners are definitely crushed right now in terms of price, and yes, they've started recovering, and they will likely continue recovering. Just, it's incredibly difficult to pick and choose which one, going to which continents, which countries will start doing better. And as a result, even if you're buying an ETF, and I'll show you an example of one of the few ETFs for airliners out there, it's a massive gamble. So I'd say in terms of risk, this is probably the highest risk out of all of these. Then out of these, again, oil, just because oil is normally volatile, I'd probably say it's the second riskiest one of all of these. Then that's actually it's a pretty tough call. Maybe REITs, and then between preferred shares and banks, I'd say probably 2 and 1, because a lot of the preferred shares happen to also be 4, 4 and 5. I'm going up that way. A lot of the preferred shares tend to usually be also preferred shares of banks themselves in many ways, right? So this is a rough estimate, but I would say yes, airlines are probably the riskiest out of these 5. Second riskiest would be oil. Third riskiest would probably REITs. Fourth riskiest, banks, and then safest in many ways, preferred shares, because again, a lot of those preferred shares are those of banks. But as with most things, the things that are safest are usually also the ones that are likely to pay you the least return, or overall returns in general. There's a couple of questions. So thanks, Pio, for asking. Yes. Yes, that, I would say that's roughly the way you summarize. That's roughly fair. Yeah. But so again, with REITs, I'd say don't focus just on the ones on retirement homes. As I said, there's a lot of upside there, but try to buy some that are a bit more diversified. The easiest way to have them diversified is literally just buy an ETF that holds a number of REITs. Okay, so I told you which sectors might be might be able to outperform the index. So now what? Well, first of all, you can use the same to figure out, to find ETFs for yourself. You can use this website here, Morningstar ETF Screener. I've shown this off at least on one occasion before. And you can literally, it's as simple as just entering the name of the ETF that you want to use, the ticker, I should say, the full name or the ticker of the ETF. So the ticker is kind of the short version of the name. And then, just look for it here, basically, right? So let's say we want to look at this one. So this is a real estate investment trust ETF. So if you're looking at this one, go. Okay, so you don't need to put the .to. I forgot. For this, some websites require .to. This one doesn't. So here you go. And then basically you can use this to assess how risky different investments or different ETFs are. And this works for pretty much any ETF. And you can look at the rating that they give it. If you want to be invested for different amounts of time, you can see how well it has performed, etc. So you can use this to do your analysis. Now, how to analyze stocks or how to analyze ETFs, that's a different topic for another time. Again, the point of today was really to show you what are and try to explain to you why some of these ETFs have dropped and why they might actually be able to outperform as things recover. Again, the big question mark that no one knows is how quickly will the different sectors recover. So now just to give you a few examples. So for real estate investment trusts, here's one of them. So that's xre.to. But as I said, with a real estate investment trust, I will be going into more detail about xre.to and 4 other large Canadian ones on June 25th. So that's like in 2-3 weeks from now. The full hour will be me spending time talking about REITs and how to properly assess them. But again, I think I gave you a pretty good idea of what some of the pros and cons are right now. So for this one, so here I'm just going, and again, this particular link I haven't included in the description. I'll include the last 4 or 5 links here that I haven't included in the description. I'll include them once I'm done with the live stream. I'll just update that description. So just have a look at it in a bit. And those of you that are in chat right now, if you really want to get to the link here, here's the link right now, basically, if you want to follow along, as it were. Okay. So yeah, 17 point. So you can see basically this is the rate of return. So it's not looking great so far, right? If you're looking at the 1-year return right now, it's 17.81% still, lower than it was last year, and basically see, it was doing well, and then yeah, that happened. And obviously we're no longer at the complete absolute bottom here. Again, it doesn't mean, however, that we're not going to have a second or a third even drop in prices here. Okay. So that's one of them, in case you're wondering, actionable examples. There's one of them. Then for banks, XFN is one interesting ticker that you can use. So I'm also going to copy that here. But as I said, I'll put all of these in the description shortly after I'm done with the actual presentation. But here's the link if you want to see it. All right. Now, the funny thing is also there's, I just realized that basically the chat is actually a bit faster than, because Google takes a little, YouTube takes a little bit of time to process the data. So the actual links show up in the chat before you hear me talking about them. So then you can notice the lag. It's about 30-second lag or so. There's nothing I can do on my end. I'm at full high speed here, but anyway. So in case you're wondering, that's what's happening there. All right, so XRE.TO, the previous one, is that it has a relatively high MER. The MER, the management expense ratio for that one, is around 0.65. This one is also quite high, 0.61. So for ETFs, these are pretty high fee ETFs. However, they do things that very few other ETFs do in the industry, and as a result, the amount of time you're saving, instead of having to buy 30, 50, whatever number of stocks individually, and the hassle associated with that, and potentially the fees associated with that, depending on your broker, it's still, the 0.61% is not great, but it more than makes up for how much time it would take you to do it manually without that. So specifically what you want to look at for this one, there's 26 different holdings. If you want to see all the holdings, here you go. So 20.67% of it is RBC, then 17.4 TD, Scotiabank, BMO, and then this Brookfield Canadian Asset Management and Canadian Imperial Bank of Commerce, so CIBC. And there's also some Manulife Financial, so a few insurance companies here as well. Okay. The risk is medium. Okay. The fee is quite high, as I said. The risk is medium. Now, I personally like investing in ETFs that have at least $500 million under management, because that way I never have to worry about them not being profitable and them shutting down. Now, if you ever buy an ETF that shuts down, no need to panic. The only time you should panic sell an ETF is if the underlying investments are about to go bankrupt or something like that, and then yes, sure, you might as well get any money instead of nothing. But ETFs, whenever they get liquidated, if it's no longer profitable for a given ETF provider, and this is true also for mutual funds, if a mutual fund or an ETF gets liquidated, you don't have to panic sell, because typically if you're selling as everyone's freaking out, that's actually when you're going to be selling the ETF. The price of the ETF will actually be significantly lower in some cases than the value of the underlying stocks that make up that ETF. Right? So in many cases, if you find out about a decent ETF that has decent companies in it, and they're, for whatever reason, it wasn't profitable, and one company is shutting down that particular ETF, that actually might be a perfect opportunity to buy it, because then you can literally buy those underlying companies at a discount compared to their current value. And then what happens is, after a few weeks after the ETF shuts down, typically within a month or so, you will get refunded or reimbursed the actual value of each one of the underlying companies that ETF makes, that ETF is made up of, right? So never ever sell an ETF or a mutual fund just because the mutual fund provider or the ETF provider said they're going to shut down the ETF, unless you do your research and you find out that the reason they shut it down is not because it's not profitable for them, but because the underlying companies are about to go bankrupt. Then it's a different story. But otherwise, yeah. And one kind of rule of thumb to significantly reduce the chances of an ETF ever shutting down on you is to only invest in ETFs that have about 500 million in in investments, because at that point they're pretty much always profitable. It doesn't say that those large ETFs will never ever shut down. It's just they're significantly less likely to shut down. Okay, so this one is almost $1 billion, so 946 million. So that's for the XFN one. So they're again invested in financial, in Canadian banks and Canadian insurance companies. The previous one I showed you was the XRE, right? So the REIT one. They have just over $1 billion under management. And I told you, sorry, and the fee, the fee used to be 0.65. They lowered it more recently to also 0.61, the same as for XFN, which again, it's still quite high for an ETF, but worthwhile given what this particular one actually does. And currently, this distribution yield is about 6% or thereabouts. Okay, so it pays a pretty decent monthly dividend. So why not? And especially if you hold it inside of your TFSA, you don't have to worry about having to pay any taxes on it, which legally. So that's pretty sweet. All right, so the next one over. So we've seen those two. The next one is preferred shares. So there's a couple of them. Actually, there are quite a few, but there's even a couple on this particular website here that you can find. So the one I'll show you is just CPD, but there's also XPF. So XPF invests both in Canada and US preferred shares, whereas CPD is only only invests in Canadian preferred shares. There we go. So CPD.to. Actually, I don't even need the .to because it'll find it like this. There we go. Okay. So same thing, just over $1 billion assets under management. It pays more than 6% right now. The risk, notice the other two were medium. This is low to medium, so the risk is even lower. It's not quite as low as bonds, but it's lower than bonds, and obviously pays a lot more than bonds on a monthly ongoing basis. And this particular one is invested in 234 different preferred shares. So quite a bit of the diversity, quite a bit of, you're lowering your risks overall. And then just XEG for oil would be here. So let's just have a look. XEG. Oh, and sorry, and their fee, because again, you always want to look at the fee. The fee is 0.5% for this one. All right. And XEG, this is for oil. And keep in mind, this is the second riskiest out of the different ones that we've talked about today. The reason it's the second riskiest is because, again, oil is very volatile. Fancy way of saying it moves up and down a lot. Okay, that's just how oil is, because oil prices get impacted by many things. And I haven't really explained it now. I just realized I haven't really talked about it because I've mentioned oil in a few previous sessions. But those of you that weren't here for that, the reason I'm convinced that oil will be fine long term is because, even the example I used to use, and I think it's a relevant one, even if, renewables become a thing tomorrow. Imagine that world governments decide, we're spending so much money right now on providing people with assistance and whatnot. What would be a good thing? Well, let's just gift everyone a $100,000 Tesla. Okay, everyone gets a free $100,000 Tesla. That way it stimulates the economy, right? Or Tesla or any other electric vehicle. $100,000. Every household just receives a $100,000 check earmarked for buy an electric car. Okay, so then imagine this happens in the whole world tomorrow. Obviously, it's not going to happen, but assume it happens tomorrow. And that way governments are like, well, we're printing money anyway, so might as well do something good for the environment. Plus, that way we'll create a ton of jobs because you'll have to make all these new factories to make all these electric vehicles, processing all to get the batteries and all that stuff. Okay, so that stimulates the economy. The governments are printing all this money. Fine. So then you're like, well, obviously this signals the death of oil. Oil is gone. And yeah, sure, we're not going to need gas stations anymore if that were to happen tomorrow. And honestly, that's the dumbest way of using oil, to just burn it for energy. The reason I'm saying it's the dumbest way is because you have so many other essential applications for oil where you cannot replace oil with anything else that is as efficient as oil. When you could argue, I guess, that oil, the reason it's so popular is because oil has one of the highest energy density, is one of the highest energy density material that is easily portable, that doesn't like blow up on you, like unlike enriched uranium or anything like that. So again, oil from an energy density point of view, it has a lot more energy output than the same weight in batteries typically, right? Now, whether that output is properly used or not, obviously, internal combustion engines are nowhere near 100% efficient, but they're not too bad, some of them. But the take home there is you're wasting it, right? You're just burning it for fuel. So it's inefficient. So, okay, fine. If you were to replace vehicles, but then there's still agriculture. A large chunk of oil is being used in agriculture. And I'm not just talking about powering your tractor. I'm also talking about all the fertilizer that is being generated from it. Right? You need fertilizer or all the various petrochemicals that are being used to boost crop yields and all these things, right? The Haber-Bosch process needs oil to function. If you want, if you're in clean tech, good luck at having clean tech without oil, right? You need oil to make various polymers. Advanced polymers are needed, whether you're working with nanotechnology or whether you're working with computers and motherboards. You need oil derivatives. So petrochemicals and various other hydrocarbons will be needed indefinitely in the future. Yes, the demand might be lower than it is right now. It'll be hopefully a different demand, but nonetheless, even if we were to switch tomorrow like this to electric vehicles, renewable energy, everything, like get rid of all the coal plants in the world, get rid of all the natural gas plants in the world, get rid of all the oil plants in the world, and replace everything with solar and nuclear or whatever, there will still be a demand for oil. So yes, it might be a different demand, but unlike airlines, which is very specific, oil is used by many industries, including airlines, all right? So because of that, I would argue, and many experts have argued, that oil, despite the fact that it's volatile like crazy, and this is why you should not be touching this stuff, if this is your first time investing, this is part of a balanced portfolio. Have most of your money in balanced, diversified portfolio, and then play around with 5-10% or thereabouts of it in some of these slightly more speculative, yet hopefully reasonably speculative investments. All right, and then finally, for airlines, there's this one here. So jets, I'm just going to copy this particular link for those of you in chat. There you go. So that's for airlines. So there are a few alternatives to this, but there aren't many, shall we say. So the issue with the airlines is, again, it's probably the most speculative out of all of the investments that I listed. Even if you're buying this ETF that holds multiple airlines. So one of its main issues is, it's been around since about 2015 or thereabouts. But you can see it's very cyclical. It goes up and down because air travel is very cyclical. There are certain months of the year where you don't go places that have massive hurricanes, or you go less so when it's monsoon season, right? And on and on and on it goes. You don't necessarily visit certain areas of the world in the summer, you don't visit certain areas of the world in the winter, and vice versa. So because of that, this is sort of what you can expect. Now, obviously, right now it's significantly lower than at its peak. So a lot of people say, well, because it's lower, well, you can make a ton of money. Well, sure, but let's just look at oil, right? XEG.to, right, was the oil one. And let's just compare them. Okay, so here's how oil has performed. Let's look at year to date. So year to date, it's still down. And then on the left-hand side over here, you see where it says percentage change. So pay attention to that portion. It says percentage change is minus 41.01%. Now, obviously, it has recovered substantially since the bottom that was reached on the 18th of March. It's gradually, slowly but surely recovering. Again, it doesn't mean that it's done, right? We had this other drop here from September 17th, 2018 to December 24th, 2019, and hadn't really recovered, right? Whereas most other sectors have recovered since, like the S&P 500, the S&P TSX, for example, and on and on and on. Oil hadn't really recovered, right? Oil, and as a matter of fact, if you're going back to 2014, we had 2015, we had that other massive hit here where it was just finally recovering and then just dropped, and same thing in 2011, right? So oil has been really, really hard hit. But just look at this, right? Right now, oil in this particular ETF. So again, stay away from individual oil companies. The ETF is safer. It's still a high risk investment. Okay, I don't want you to be under the impression that oil is safe, right? So it's 0.61. Look, this is high, right? Remember, the banking one was medium. Most of them were medium. Then the preferred shares one was low to medium. Remember that? This one's high. Jets, if I had to put it on this, is probably very high. It's like off the chart here. Okay, this thing. Okay. Now, good news about it. It also has 985 million assets under management. So it has a lot of the same kind of utilities, or a lot of the same features I'm looking for in an ETF. It does have them, but again, much higher risk. The expense ratio is very similar to all the other ones at 0.6%, as you can see here. Another thing to keep in mind, all the other ones are in Canadian dollars. This one is listed in US dollars because it's trading on in the US. So because of that, obviously, you also have to deal with the Canadian currency conversion rate whenever you're buying and or selling this thing. Okay, which sometimes that can help. Sometimes currency risk is another potential risk, right? So let's just superimpose on top of this jets, right? Just to see, because those are, again, jets and then the oil one are really the two riskiest ones out of all the ones that we've been talking about. I'm going to put jets in red. And first of all, yes, the oil one has been around for much longer, but that's not necessarily I wouldn't necessarily say that that's a deal breaker per se. But right, so let's have a look here. So it goes back to, there we go. So roughly May 2015 or thereabouts. And yes, sure. And if you're trying to find a deal, yes, airlines are down, but oil is battered more. And again, provided you have a long time horizon, it'll probably do okay. But again, very high risk. It's not for the faint of heart. It's not something you should be going all in just this. But just FYI, I personally have been dollar cost averaging into this for the last. I mean, I've been holding this for a couple of years now, and just buying it when it's on a dip, selling it. I've sold a little bit sometimes when I buy it, on random dips like here, and then sell it a few months later when it would just go high for no reason or for no apparent reason, just to even things out a bit. So again, I'm investing in it, but I have many other investments, and this makes up about 2% of my portfolio. So it's to me, even if it goes to even if it loses 50% of its value from here, it's a minor impact, a minor inconvenience on my investments. But just something to keep in mind. Now let's put comparison here, and then I'm 2 more minutes and I'll be done. Sorry. So actually, no, I meant to. Let's go back, and I'll just add it. I'll add it over here. So CPD is the preferred shares one, right? So keep in mind, this will be pretty much one of the safest options out of the ones that are listed here, right? CPD, there we go. And let's put it in green, okay, just so you see how it's doing. Okay, what did it? I'm going to add jets back in because that should not have removed it, but sometimes this bugs out a little bit. Okay. All right, so CPD is in green. Remember that. So actually, let's look at the 1Y. So that's 1 year, okay? And so yeah, CPD has dropped, but you see it's dropped less, but it's still at a significant discount compared to what it used to be, right? So especially if you're looking at year to date, right now, so it's still at quite a discount compared to at the beginning of the year, and it pays out about 6%, 6.3% in dividends. So that's pretty, that's pretty sweet. So basically, where you could. So thanks for the question, Chuka, and here you go. You can just use this, which is, again, you actually already have this link in the description of the webinar, of the live stream. But yeah, you can click it there. So you can use Morningstar to sort of evaluate these, all right, and just see if they're in line with what you're interested in. All right, there. And let's just put, finally, let's just also add XFN, right? So that's the finance one. And we're going to add this one in purple. I'm just trying to find colors that are as diverse from one another. You see also drop, drop barely. It's pretty much at the same level as the preferred share one. Okay. Now preferred share one pays more in ongoing dividends, but it's usually less likely to increase as much in price. So the preferred share one won't make you quite as much money, but again, it's also the lowest risk out of the bunch. And typically, risk reward, right? Association. So the higher the risk, the higher the potential reward. You're welcome. All right, so we have that. And then finally, let's XRE. Let me put that last one. So XRE. .to is this one, and let's just pick, we have like a brown, there you go. Oops, I pressed cancel, that was my bad. XRE, there we go, and this, and brown, and save. And here's the ETF one, okay? So, as I said, it's not particularly surprising that the one that has dropped the most and is doing kind of the worst short term is also the riskiest one. If you're looking at 1 year, it's still the two highest risk ones, the oil one and the air travel one, that are doing the worst. Now, one last bonus, since you guys have been sticking around for an extra 13 minutes after my, because again, usually this is around 1 hour, but sometimes like today I'm going a bit over time because there's a bit more stuff that I'd like to share with you. There's a really interesting ETF, which again has some pros and some cons. Okay, those of you that have attended some of my webinars at Concordia or McGill, you will have heard of this one before. FIE.to. Okay, so this one is a bit of a special case. It's a bit of a mix between preferred shares and financials. So it's like if you want to buy both preferred shares and financials, this might be an interesting way of mixing things up. Now, one kind of asterisk, it's not merely invested in CPD, because it is invested in CPD itself, and then in some financials and actually I think it has probably one small REIT or two REITs in it as well. Let me just put it in. I'll put it in pink just because that way it stands out from everything else. Okay, so it's right here. Okay, you see it? So FIE.to, you're buying this thing for cash flow. You're not buying this ETF, for price appreciation. Normally, it's ridiculously steady, ridiculously stable, as from a price action point of view. So let's just have a quick look at it. It also has the highest. Fee out of all of these. So that's a downside of it. So it has $609 million, right? So that's enough. Here's the fun part about it. Current yield 8%. So monthly you get 8% divided by 12. So you're getting 4 cents every single month, and you can buy it currently for about $5.94. All right. So this thing is all about cash flow. If you want steady income every single month, you buy this thing. Plus, right now, again, it's pretty much at a historic low when it comes to actual price. So you have it. It has a good chance of recovering as bank shares, as preferred shares recover as well. I'm just gonna open a new tab here just so you can see it separately from everything else. All right. So FIE. I'm sorry that. Okay, it's remembering all the other ones. Let me just remove these from this one. I hope it lets me just keep one of them open at least. There you go. Remove that, and remove that. Okay. So if you're looking at the 1 year rate of return, again, left, you see you technically lost 12.09%. But again, don't buy this thing if you need the money in a year from now. It's just if all you care about is cash flow, this is a great. And you see like 4 cents. They've been literally paying 4 cents on an ongoing basis. Now, a lot of my students that were asking about this thing back in March, when it was trading below $5, I mentioned to them, look, this is not a surefire thing, but have a look at it, because again, it's mostly invested in banks, and insurance companies, and it also has about 30% of it in that CPD ETF. Now, the downside, as I pointed out before, is the fact that it has a very, very high MER, specifically 0.96%. So it's quite high. The risk is medium, so it's a bit higher risk than just the preferred shares, because it's a mix of preferred shares and actually also has some bonds and then also banks, right? So specifically, no, so there's basically it holds XCB, so those are Canadian bonds. About 10% of it is in Canadian bonds and about 20% of it is in preferred shares. So about 30% of it is relatively safe assets. And then everything else here is, so yeah, if you're looking at there are 27 different holdings, and then obviously CPD is made up of 200 and whatever, 34, or whatever number we've seen before, individual preferred shares. But again, the rest of it, you see, basically has CIBC, exposure to CIBC, National Bank, RBC, Bank of Montreal, TD, Power Corporation, Sun Life, Manulife, right? I just want to show you all the holdings here, just so you get a better picture of what this thing is. Yeah, Sun Life, Bank of Nova Scotia, IAG, Brookfield, Gen Growth. So this is basically one of those, Home Capital as well, Equitable Group. So that's from Equitable Bank, Laurentian Bank, Great West. And now those of you that have heard, I don't know if you've, and also RioCan Real Estate. So as I told you, they also have a few, GRT here, Granite Real Estate, and Car Real Estate, right? So Canadian Apartment Properties Real Estate. So there's a few real estate investment trusts, some preferred shares, some bonds. So this thing is almost like a portfolio in itself, if you want to think about it that way. The reason I advise some caution when it comes to this is simply because you might be thinking, well, none of the previously mentioned investments offered an 8% payout. These guys are invested in a lot of the stuff that you just mentioned. How can they afford to pay us 8% if the underlying investments don't pay them 8%? Like, what's the catch? What is this, a pyramid scheme? No, it's not a pyramid scheme. However, if you're looking at the specifics, if you're looking at the distributions, all right, just if you're looking at the chart here, the distribution chart, right? So it shows you literally for every single month it pays, 4 cents. If you're looking at calendar year, so 48 cents per year, obviously 4 cents times 12 gives you 48. So not a surprise there, I hope, for anyone. And from 2010, again, 2010, they didn't have the full year, so that's why it paid out only 34 cents. But the rest, it was literally 48 cents every single time. Now, the reason I'm saying is, yes, the dividends that the underlying companies pay them, it's the eligible dividend. So, 26.916 out of the 48 cents were eligible dividends, if you're looking at the 2019 numbers. Okay. There's also now every single one of those companies has the potential sometimes to also pay out part of their dividend in the form of not only eligible dividend, as is the case there, but also in the form of some capital gains. Now, this particular company, the way they're able to pay you out more than the underlying companies pay them is they tend to usually keep some money on hand and then buy more of their own shares when the price goes down, and then start selling some of their own shares into the market as the price goes up. And as they're doing this, they're actually realizing additional capital gains on top of the capital gains that are already included in the dividends that are getting paid out. And as a result, they kind of boost up the underlying payout. So if bank shares pay you around 5% and the REITs pay you around 6.3% and the preferred shares pay you around 6%, they're buying their own shares at a slight discount, reselling them when they're going up, the way they just did now. Again, right now it's super cheap to borrow money, right? Especially if you have a decent credit rating. And as a result, they're able to continuously pay out a bit more than what the underlying investment. So it's not a pyramid scheme. It's just they're kind of doing this and kind of flushing money through the system, as it were. Now, this procedure is legal to do, but obviously there are some potential risks involved with doing it this way. So I just want you to understand that the reason this particular ETF pays out more is because they do this. And this is also part of the reason why their fees are higher, because it involves more active, buying and selling of their own shares on top of just holding the underlying shares of the underlying companies in there. So again, it's not something that is right for everyone, but just, FYI, okay? And it's definitely, right now, it's definitely, at a low price. And you see, historically, it usually fluctuates very little, right? So there you go. All right, and last, my final concluding slide here. So wrap up, nobody can accurately and consistently, again, as always, the keyword is consistently. I know I've said this probably 20 times, even just today, but it's incredibly important to understand that all I'm telling you is these are kind of educated guesses based on my own analysis, based on the analysis of multiple actual experts in the field talking about each one of these investment options. So I might be wrong, they might be wrong. Just be aware of that, right? So balanced diversified portfolio is probably going to outperform most of these in the long term. Short term, right now, there's a good chance that some of these might outperform the index over a certain amount of time. The key question is, what is that time? No one knows for certain. That's why primarily focus on balanced diversified portfolio, and then a small percentage of that can be one or a number of the ones that I mentioned to you today. With, keep in mind again, the jets one, the one that is investing in literally jets and airliners, that's the highest risk one, and also has the added slight inconvenience of being traded on the U.S. Stock exchange. As a result, you need to also you're stuck kind of doing a currency exchange, and the downsides of that basically. Different sectors will recover at different rates. That's an incredibly important thing to keep in mind. Okay, it's very hard to predict which ones will. I hope in the little analysis that I gave you today kind of give you some ideas, which I'm sure you've heard some of these things before as well. It's not, I'm not presenting brand new content here by any means. Only invest if you can ride out the ups and downs to come. That's another key take home. If it's money that you need for the short term, don't invest. It's not right for you right now. And even if you're in it now, imagine how frustrated you would be if you're investing in the right ETF right now, or even in a balanced diversified portfolio right now. But then 3 months from now, there's a second wave, and 3 months from now happens to be the exact time when you need to sell, and you're selling at, maybe in the meantime prices go up by 20%, but then they crash 40% in a few months from now. No one knows, right? So only invest money that you can afford to have in the market for at least 5 years, ideally a bit longer, and all the other things that I previously said. So I hope you found this session interesting. If you have any questions, again, I can stick around for a little bit to answer them now. Otherwise, just write a comment and I'll get back to you. Usually, within a few minutes or a couple of hours, depending on the case. And again, because there's roughly a 30-second delay, I'll just wait maybe a minute or so to allow if any of you have any questions for the video to catch up to me waiting right now to see if there's any questions in the chat. Because as you type the chat, I see it in real time. You just hear me and see me about 30 seconds after I say things. So yeah, I don't see any questions coming up just yet. All right. Well, I think that's pretty much it for everyone in that case. So, thank you so much for your time, and I hope this was useful. And again, next Thursday, 3 p.m. again, roughly an hour long session on. Oh, actually, what's next? What's next week? Good question. I forgot what. Advisor. I think the next week is the advisors one. So next week I'll be talking about advisors specifically. So we'll be talking about questions to ask your advisor. Again, if you're one of my students, you've already seen this probably. But if you're not, that's a really useful session, and that one will definitely be about 55 minutes at most an hour. That's pretty straightforward. It's whenever I'm trying to do live analyses of ETFs and show you examples, that's when we go a bit over time. You're very welcome. But yeah, so these are the upcoming sessions, and again, starting in late July, I'll actually start posting short 10 to 15 minute videos as well, which are nicely edited. I've been having a crazy schedule lately. So anyway, Any questions, just post them in the comments. This video will remain public, and I'll make sure to update the links to everything else if you haven't copied them already down. And yeah, so have a great day, everyone, and I'll see you next week. Take care.